My name is Daniel, and I want to tell you about the day I watched three people open the exact same brokerage account and somehow walk out with three completely different financial futures already baked in, without any of them realizing it had happened yet. It was a work happy hour, nothing special, the kind of forgettable Thursday where somebody's promotion gets a round of drinks and everyone pretends the office small talk is fun. Three coworkers, all in their late 20s, all earning close to the same salary, all sitting on roughly $10,000 they'd been meaning to do something with for over a year. And that night, half fueled by confidence and half fueled by two drinks, all three of them pulled out their phones and actually did it. Same brokerage app, same $10,000, same 5 minutes. But if you looked closely at what they actually typed into that search bar, you'd already know, before a single dollar moved, which one of them was setting himself up for a decade of quiet regret. Not because of the fund, because of the person. The first guy, let's call him Marcus, went with the boring choice, a total U.S. stock market fund, something that basically owns a tiny sliver of every publicly traded company in America, from the household names to businesses you've never heard of that make industrial adhesives in Ohio. It's the financial equivalent of ordering the same reliable sandwich you've had 100 times. Nobody's ever bragged about it at a party. The second guy, Priya's husband actually, we'll call him Dev, went a different direction. A growth-heavy tech fund, loaded with the companies everyone already talks about at dinner. The chip makers, the cloud giants, the ones whose stock charts look like a ski jump. And the third, a woman named Renata, who'd just gotten out of a rough divorce and wanted her money to feel dependable again, picked a dividend-focused fund. Dozens of older, unglamorous companies that had been quietly cutting checks to shareholders for 20, 30, sometimes 50 years straight. Here's the part that should genuinely bother you. Over the next 10 years, the math almost didn't matter. What mattered was what each of them believed about their own money, and that belief is what quietly decided the outcome long before any market crash ever showed up to test it. Let's talk about Dev first, because his story is the one everyone thinks they already understand. His tech fund had a wild first 2 years, up nearly 40% combined, and Dev became the guy at every gathering who somehow steered the conversation toward his portfolio within 11 minutes. He wasn't lying about the numbers, that's the uncomfortable thing. The fund really did that well. But here's what nobody tells you about a fund that can climb 40% in 2 years. The exact same mechanism that lets it climb that fast lets it fall that fast too. And eventually it did, dropping around 32% in a single stretch during a rough stretch for tech stocks. On a $10,000 starting position that had grown to almost $16,000, that crash erased more than $5,000 in a matter of weeks. And this is where I need you to sit with something uncomfortable for a second, because it's the actual subject of this video. Dev didn't lose that money because the fund failed. He lost most of it permanently because he sold near the bottom, told himself he'd get back in once things calmed down, and then never did, because the emotional wound of watching $5,000 evaporate made the whole account feel radioactive to look at. Now, here's a thing I think gets buried every single time this topic comes up, and it's the actual reason I wanted to make this video instead of just another index fund comparison script. The dollar amount you lose to a crash is rarely the real cost. The real cost is the years afterward when you're too scared to reinvest, sitting in cash, watching the market recover without you, because your nervous system learned a lesson your brain never agreed to. Researchers who study this call it the behavior gap, the difference between what an investment actually returns and what the investor holding it actually earns. And depending on which study you look at, that gap runs somewhere between 1 and 2 percentage points a year for the average person. That sounds small until you drag it across 30 decades on a growing balance, at which point it quietly amounts to tens of thousands of dollars, not lost to fees, not lost to a crash, lost to flinching. Marcus, meanwhile, had the most boring decade imaginable, and I mean that as the highest compliment I can pay an investment strategy. His total market fund did fine. Not spectacular, just steadily, unglamorously fine, drifting up around 9 or 10% a year on average, with the occasional scary dip that recovered in a year or two like it always eventually does. And because there was nothing exciting to obsess over, Marcus basically forgot the account existed for long stretches of time, which turned out to be the single greatest advantage he had. He wasn't disciplined, he was just bored into good behavior, which honestly might be the most underrated wealth-building strategy that finance content never talks about. And Renata, the one everyone assumed was playing it too safe, by year 6, something interesting happened that nobody at that happy hour would have predicted. Her dividend fund had grown slower in raw price terms than either of the other two, but the checks landing in her account every quarter, small at first, maybe $80, then $110, then closer to $160 as the payouts grew, gave her something the other two didn't have during rough markets, cash she didn't have to sell anything to get. When the broader market took a scary dip in year 7, Marcus and Dev both watched their balances drop and had to decide whether to sell. Renata just watched her dividend checks keep arriving on schedule, and that alone kept her from panicking because part of her return didn't depend on the market's mood that week. By the way, if you're the kind of person who actually wants to sit with numbers like this instead of just nodding along and forgetting them tomorrow, that's the exact kind of viewer this channel is built for. So go ahead and hit subscribe because we get into this stuff every week. Now here's where I want to slow down, because the obvious lesson people take from a story like this is just buy the boring fund and never look at it again. And honestly, that's not wrong, but it's incomplete. And I think the incomplete version is what makes so much finance content feel hollow. The real lesson is that each of these 3 funds was a reasonable choice. The disaster was never the fund. It was the mismatch between what each person actually needed emotionally and what they picked based on which one sounded most exciting at a happy hour. Dev didn't need the fastest fund. He needed a fund boring enough that he'd never be tempted to check it during a bad week because his personality made him allergic to patience. Renata didn't need the safest fund because she was weak. She needed cash flow because her actual life circumstances, rebuilding alone after a divorce, made unpredictability feel unbearable in a way it might not for someone else. And that's the part almost nobody says out loud in these videos. Your risk tolerance isn't really about how much volatility you can mathematically withstand. It's about how much volatility you can watch without doing something stupid at 3 in the morning. 2 people with identical incomes and identical account balances can have wildly different correct answers because the real asset you're managing isn't the money, it's your own future behavior under stress. And most people have never once sat down and honestly asked themselves what that behavior actually looks like until the market forces the question on them at the worst possible moment. If there's one habit worth stealing from all 3 of these people, it's not a fund, it's a rule. Before you touch that buy button, decide right now, while you're calm, exactly what you'll do when the number drops 30%, because you will not be thinking clearly when it actually happens, and the version of you making that decision in a panic is not the version of you that should be trusted with it. Write the rule down, read it back to yourself during the scary week. That single habit will do more for your account over 30 years than picking the theoretically optimal fund ever will. So here's my actual question for you, and I genuinely want to read the answers in the comments. If your account dropped 30% tomorrow morning, be honest with yourself for a second. Would you hold, or would you be the reason your own investment failed?